care how good you are in anything, you don't have discipline, you ain't nobody.
Right.
You're nothing without discipline. Because you give up on the slightest struggle without discipline. Discipline is doing what you hate to do, but do it like you love it.
Here with Andrew Thrasher today. So I've always been interested. One, his name always stood out to me just because I was a BMX rider, and Thrasher was an interesting thing in skateboarding back in the day. So I always thought the name was cool. I like Thrasher Analytics as a cool name. And then going through his papers, I learned a lot about volatility and just learning from someone who really dug into it so deeply. And he's won a couple awards, Dow Awards, correct? So I mean, he won a couple awards. He's a portfolio manager. Also runs Thrasher Analytics. How are you today, Andrew?
Doing well, doing well. Appreciate having me on.
Good, man. I'm so glad to have you on. I followed your stuff for years. I always was interested in having you on. And like Adam came on the other day and he was like, you got to talk to Andrew. And I was like, yeah, I really do. And I was like, so I hit you up. I'm so glad that you were available and down to come on. And
Yeah,
so
definitely.
today I just want to run through some cool stuff with you because, in general, I think the way you look at trading, the way you look at markets is very conducive for people who are new to trading to try to understand like how trading really works compared to how people think it works. We're not people who sit in a room. I mean, you're a portfolio manager as well, like myself. We're not people who sit in a room and go, man, let's pick that stock. It'll be great. We'll make $1 billion. We'll put 1,000% on X. We are people who come up with strategies and we have a methodology. And so, can you run a little bit through your methodology of how you look at markets?
Yeah, so I think it's the first place to start with. So I'm a portfolio manager for an RIA, Registered Investment Advisor. So we work with primarily different households. We also do some corporate stuff, some 401k work, but we're working with people who are primarily retirement focused.
Mm-hmm.
So it's not necessarily a 32-year-old who's trying to really accumulate his assets. It's more people who have accumulated a fairly significant net worth for a lot of the families. And they're looking at how to turn that into an income stream, how to turn that into a legacy or an estate to pass on to future generations, how to then live in retirement. And so we're much more risk focused. We're not trying to hit home runs. We're not trying to find the next Google or the next Amazon that's going to be a 100-bagger in a couple months. That's not our objective. If it happens, wonderful. But that's not what we're trying to screen for or do. We're really trying to manage downside volatility, try to kind of we had one client who told us that our job is to make their life as boring as possible. And that's true. We're trying to let them sleep at night, let them have minimal volatility in the portfolio and see some accumulation, of course. But so we're very risk focused. We're trying to kind of have a diversified portfolio, but we take the diversification. This, I think, probably answer your question. We do strategy diversification. So we don't really hone to the efficient frontier. And just by having a little bit of stocks and bonds and all that and everything is good to go. We believe that when you truly need diversification is when diversification disappears. When we historically look at times where COVID crashed, the financial crisis of 2008, anytime the market really has had an increase in volatility and large drawdown, correlation essentially goes to 1. And so we don't believe that just having a large basket of stocks is really diversification. So we approach the market from a multi-strategy approach. So we'll have a portfolio that's having maybe 7 or 8 different strategies, different ways of looking at the market, whether it's equities, fixed income, commodities, what have you. And so they're all independent. They're all different. Some may do really well in certain market environments. Some may do better in other types of market environments. But ideally, you have one that's at all times doing something working well. And as combined, they're able to create that portfolio and create strategy diversification. Something Ray Dalio talks a lot about, having different sources. He's probably popularized that concept, but so we try to look at from a strategy diversification perspective, and then adjusting risk based off different types of portfolios that we manage. But that's kind of our primary focus, is more kind of risk management. That's why I wrote the paper on volatility. That's constantly what I'm thinking about, and I know we'll dive into that later. But yeah, so we're pretty systematic. We do have some discretion with some of the stocks that we pick or the investments we make, but we do try to be as quantitative as we can with how we're approaching the market.
No, I love that. And and it's something that I also tell people who are on the younger side too, is when you start trading, you do look for those 100 baggers, you're looking for the
Sure.
next Bitcoin or whatever. And really it's like I know more people who have accumulated wealth by just being safe than people who have just tried to do 100 baggers. Because 100 baggers can also go to zero. This happens a lot. You could dump your money into some crazy cryptocurrency. That happened a lot in 2016, 2017. I watched it happen to all my friends. They dumped it
Yeah.
into some new coin that was coming out, and it was some new ICO, and they would take, 30,000, 100,000. I have a friend who took millions and put it into these things, and it all went to zero. And he'd send me these things, years later, like, look, it's worth zero. Like, it's funny. And it's like, if that was just $1 million just gaining 10% a year, compounded together for 10 years is a lot of money. I mean,
Sure.
that's almost 10 years ago now. That would have been worth a lot of money. So I think
Yeah.
it's very important to, as you talked about, is to hedge that downside, to open up that upside. Because
Mhm.
if you're constantly just worried about making money, like, you're also going to open up the floodgates for volatility. And when volatility starts flooding in your portfolio, then you're trying to get yourself out of drawdowns all the time. You're not making money. It just doesn't work that way. Protecting, like, as you know, and anybody who's watching this who doesn't know this, a 50% drawdown takes you 100% to get back to normal.
Right.
So of course you got to protect the downside. And I love that, we could hop right into that next, which is the volatility tsunami. So tsunami, tell it for people who've never even heard of this before.
Yeah. So
what
in
exactly did you write there?
Yeah, and so in 2017, I wrote a paper called "Forecasting a Volatility Tsunami," and that was the first Charles Dow Award that I won, which is given by the CMT Association. They do a kind of a blind reading; they don't know who the authors are of different research that's submitted, actually across the world, because CMT is a global organization. So there's been people from Europe, from Asia that have won it, and so they read all the papers. There's a committee, and then they choose what they believe is the winning paper. And so in 2017, my paper on volatility won that award, and then actually won it again this year for another paper we can dive into later. But the volatility tsunami one, what got that started was my again, since I focus so much on risk management, is looking at the VIX, and obviously there's a most of the time a negative correlation to the VIX index, which is like the fear gauge. Whenever equities start to decline, you see the VIX will often spike or explode higher. And so because we're not overly short-term focused, we're not looking for just tiny little wiggles within the equity market or the VIX index. We're looking for those material drawdowns, those ones that can actually impact someone's financial life. And so we found that when the volatility index spikes and sees a dramatic increase, that's typically when the times in the equity market that you want to be ideally either out or hedging or doing something protective. And so I started down this path of looking at, is there any commonality to when the VIX spikes? Is there any type of pattern or indicator or any type of source of data that often precedes these big volatility spikes? And so that's what the paper kind of dives into, discussing how it's not necessarily when VIX is really low. That's a common misnomer, that because the VIX is really low, that's when volatility spikes higher. Traditionally, actually, when VIX is low, and we've seen plenty of periods of that it can stay persistently low for a long period of time. 2017, actually, ironically, when I won this paper on volatility, was an extremely low volatile year. But then we saw that at the end of 17, in 2018, in January and February, we did see a big spike. And there was a pattern that arose during that. And so they also looked at, is it just when the volatility drops a lot? Like if it drops quite a bit, then it's going to spike higher. It's because it's mean reverting. And so I found that really wasn't a great predictor either. And so went down this path and found one thing that does precede just about every spike in volatility was a narrowing of dispersion. And dispersion is just a fancy way of saying standard deviation.
Hmm.
So plotting standard deviation on a chart. So when I found when standard deviation gets really low, it's basically what I believe kind of a sentiment gauge for the VIX, or really for other assets as well. But when standard deviation is low, it's just telling us that that asset we're plotting on, so for the VIX, isn't doing a lot of movement. When standard deviation is low, that means it's not seeing these big up moves, big down moves. It's just kind of staying consistent. It's kind of getting complacency. So if the VIX isn't moving a lot, I believe that's the market kind of getting a little complacent, overconfident, that it doesn't believe that they're going to have a volatile event. And so these types of environments, I always call it kind of the door being open for a volatility spike, because just because volatility gets really compressed and standard deviation gets low doesn't actually mean it has to spike higher. But we very, very rarely ever see those volatility events occur without having dispersion get really low. Even to the point during the COVID crash, before the COVID crash and kind of this big tail event occurred, before that, we actually had volatility got really compressed. So you didn't need to know there's going to be a global pandemic, the world's going to shut down to know that volatility might move. You just say, hey, the market's kind of over complacent right now, looking at what volatility is doing. And then you kind of see that the history books will tell us what the ultimate cause was. And so we see these periods to where it gets really compressed. Maybe it takes a couple of weeks to unfold, and maybe volatility doesn't do anything. But we traditionally, if it's not compressed, we very rarely see volatility see major spikes. Of course, it can happen, but it's been very rare. And so that's why I do a lot of writing and Thrasher Analytics and the assets that I manage of when we're in those periods of time where dispersion's really, really low, start looking for other sources of data. Is there anything else that kind of confirms that? Whether it's an increase in correlation to equities, is there anything going on with breadth? Kind of looking at all the other pieces of data that we have access to. Is there anything else saying, yeah, this is maybe a higher risk type of environment? And that doesn't necessarily mean we want to take all of our chips off the table, but we want to be cognizant to the decisions that we're making. And so as we record this on January 10th, we're kind of in that environment right now, and we have been for a couple of weeks. And so those periods can persist for a while, but we are in that kind of overly complacent type environment for volatility. And we see it with some of the other sentiment data. Looking at some of the surveys, position reports, we are seeing kind of a higher degree of sentiment. And so then we're looking for, does the market start to confirm that? Do we start seeing volatility rise? Do we start seeing weakness in equities and start looking for those types of confirmation to say, okay, now the market's kind of starting to acknowledge that complacency, and then we can start deciding if there's any decisions we need to make within the portfolio or positioning or things like that.
No, that's perfect. And really that's one thing that you taught me that, I think it's hard to really explain things like that well and in an exciting way, and you just did, and that's amazing.
Nice.
But that was the same with your paper for me. It was like the first time I was able to really like grasp that concept and build systems based on it. I really didn't understand how to build like a volatility system, something that just takes advantage of low volatility turning into high volatility.
Mhm.
That kind of helped me to understand certain things a little bit deeper, like even a band squeeze. Something like
Yeah.
a band squeeze on a Bollinger Band squeeze, understanding that to a point where you can be like, okay, well, like you said, those periods of complacency, and it's the thing that you really talked about a lot in that paper too, is low volatility leads to high volatility. High volatility can lead to low volatility. And when you're in that period of extreme complacency, you can really make some major moves. You can buy options in those periods of time and they get very cheap. You can be set up for a major spike in the VIX. You can get set up for a possible event happening. And really it's becomes this very high reward, low risk trade. And that's what we're always looking for,
Mhm.
because basically when you're looking at something like the VIX, you could have a huge move. You could have a humongous move and make a lot of money. And once again, I think one of the best things you said in there was, we don't have to know that COVID was going to happen.
Right.
I had no idea COVID was going to happen, or COVID was happening, but the shutdowns, like I had no idea we were going to shut down. Everybody talks about it. Yeah, sure. I thought it was possible, especially when it happened in China, but I wasn't thinking it would be that catastrophic or any of those things. And then we did, but I was positioned. And how did I do that? I was positioned well just because of things like this, like VIX is incredibly low. We start to move out of that range. Trends start to flip. I wasn't just shorting on the way up and knowing it was going to happen. I was waiting for the trends to flip. And so like I love that whole paper. I will put a link to that paper in there. And so let's hop right into your next one. You just won the Dow Award again. And another award, I think. There was two awards.
The Founders Award from the National Association of Active Investment Managers. They're the ones they're well known for, like their exposure index.
Nice.
For their survey of how like investment advisors are positioned. So they're similar process where they look at a lot of research and pick a paper. And so I think the reason that I look at the market as simplistically as possible. I don't have a PhD in mathematics. I'm not a computer scientist or an engineer. I have a degree in finance. I've done this for over a decade. But I try to look at things as simple as possible. And so that was the same thing for the other paper that I won this year. It was called the 5% Canary. Yeah. And again, kind of looking at it, the paper was broken up into two different parts. One kind of was more of a risk management approach, and one was looking for opportunities. And we saw this play out in the third quarter of last year, actually. And so what that paper looks at kind of briefly is when the market declines 5%, how long did it take to do it? And so what I found was that if the market moves down 5%, in the paper I look at the Dow and the S&P, and then I also look at a lot of foreign markets as well to kind of show it's not just a US based thing. But in the paper I really focus on the Dow and the S&P, not so much the Nasdaq because it can be more volatile. So I think it does. You have to be kind of aware of how volatile the index is that you're using. And there was nothing special really about 5%. Again, as a portfolio manager, I'm really not concerned about 1 or 2 or 3% moves in an index. Those are kind of just rounding errors for the time frame that we're looking at the market for. But 5% can lead to 10, 15, 20, 30. So when that first 5%, what I wrote in the paper is if it happens very quickly within just a couple of weeks, that historically that has set up for a larger decline. If it takes a long time for the market to decline just 5%, and that's actually what we saw in the third quarter of last year, it took a long time to finally get a 5% decline from a 52-week high, that traditionally those were less supportive declines. There wasn't enough supply coming into the market, that they were likely just to be short-lived drawdowns and likely to either the market was going to become oversold, test its 200-day moving average, and likely to rebound. And that's exactly what we saw in October this year. We got the market just barely oversold, and then we ripped higher in November, December of this year. And it was after we had, I think it was 20 plus days to get to a 5% decline. So when we had that, I was able to say, okay, doesn't actually mean the market's going to reverse right now, but there isn't a lot of selling pressure, a lot of support from the sellers to really push this market lower. And so it's probably not going to be a repeat of 2022. We're probably not going to see a multi-month decline of down 20% based off how long it took the market to go down 5%. Whereas if it is a much faster decline, if we do see a lot of sellers coming into the market kind of right away as the market's just down 5%, happens within a week or two, that's something there is a lot of selling pressure. There is more motivation for more downside. And we saw that in January of 2022. After the first decline, it happened in just a couple days. We were down 5%. And in the paper I wrote that the way to then confirm it is, okay, we have this event. It happened in a short period of time. Then what's the way to confirm or kind of brush out some of the noise of when this happens a lot? And so I wrote, look for confirmation from the 200-day moving average. So, okay, we've drawn down 5%, happened within, say, 10 days, and then the market breaks its 200-day moving average. That's often told us that kind of confirmation really says, okay, we really are going to start seeing something likely to be protracted and to be a more significant decline. So that's kind of the thesis of the paper. Very short declines versus very large declines. Short declines can lead to protracted downturns. Longer term declines that take a long time to develop create more buy the dip opportunities. And so I kind of look at not knowing when to buy the dip. It was a really popular trading when in 2020, 2021, when everything would just bounce. Everyone got really confident in the idea that just buy the dip. But that can often cause a lot of harm, as we saw in 2022. And I tell a short story in the paper that Newton tried to trade the South Sea stock, what became the South Sea stock bubble, when he constantly was buying every dip in that stock. He was doing it in a trust, and actually put the chart in the paper. You can actually see all of his buys. And then when the bubble kind of burst, as we look back, and he continued to buy, and that's where he really had a lot of financial trouble. And then his famous quote is that he can chart the stars or whatever, but he can't understand financial markets or whatever the quote was. But this really smart mathematician, really smart guy got beat up in the stock market because he got overconfidently buying the dips. So applying this type of approach, saying, okay, it took a long time to climb 5%. This is probably going to be that type of environment where we can maybe look for a dip to buy in this index. So it was a great example this year. We did continue to see the market decline further. It wasn't just a 5% immediate bounce, but we got oversold. And I was tweeting it kind of live while it was happening that we're probably going to get oversold. We're going to test the 200-day, and that will probably be what we see the market bounce. And that's exactly how it played out. It doesn't always work that way. But that was kind of the general theme of the paper, is looking at those initial 5% declines, that being kind of the canary in the coal mine, which is why they're called 5% canaries, saying, hey, this is something's going on here. The market's declining pretty quick to get down 5% in a couple weeks. Maybe this is going to lead to something else. Then we start again. You start looking for confirmation. What's breadth showing? What's momentum showing? What kind of the market leaders, what are they doing? And start to really dive into the analysis of the market, not just relying on one piece of data, to start saying, okay, do we need to start making adjustments to positions, to how we're exposed to the market, and so on. And that's exactly how we we approach the market using both the VIX paper and this paper. I use them within the assets that I manage for the RA that I work for.
Nice. No, I love that. And that's the most important thing that we do as traders and asset managers. Our goal is to manage risk, and if we can find tools to help us manage risk, even better. So I love that whole idea, especially because it just this year was perfect. And you have like a knack of doing that. I think that's what, even like meeting you, I was always like, I wonder if he is an engineer or something, because just the way you talk about things and know things so deeply like this. And people ask me if I'm a coder all the time and stuff, but so I guess I have to ask, how did you learn all this stuff? How did you kind of get into this realm of finance? Because even a lot of people in our field, they get into fundamentals. You got Adam's very similar to us, where he's also looking at the charts. You look at the charts. How did you get into looking at the charts over the fundamentals?
Yeah, so I went to Purdue University, which actually is a great engineering school. Wasn't where I was at. I was on the business finance side. Got a degree in financial planning, then worked for another firm down in Florida for a couple of years, and was more on the advisory side, meeting with clients, going over financial plans and talking about their investments, and then shifted over more towards the portfolio side as an analyst. And then I've been at my current firm for this will be my 12th year. I've been there 11 years right now, as purely as a portfolio manager. And so I think everyone kind of your initial foray into the markets for most people, especially if you started in academia, is a fundamental lens. That's what I was taught when I took a trading class or an investment class. It was all about Ben Graham, moats, looking at valuations, and I managed money alongside a CFA, Adam, who that is the lens he looks at it for. So he looks at it more from the company specific approach, and then I'm looking at it more as the actual investment and stock side. And so we work well together in that. But I went into the Ben Graham, all that is just, it didn't make sense to me. I didn't see how, if I'm doing all this work and everyone's doing all kind of the same work and finding these companies are extremely undervalued, of how long can that last? Because then I would look at the stock history and say, well, it's been undervalued forever. What's going to make the market recognize that it's undervalued and should be whatever price? And so then that led me kind of learning about what technical analysis was, started reading books on it, found about the CMT Association, took those exams, became a chartered market technician. And then that's just the type of analysis that makes sense to me. I guess I'm very visual, so I like charts. I like manipulating data. And I'm also just extremely curious. And I think that's a common trait for a lot of technicians. Because we have so much access to so much data, it changes every day. Whereas more fundamental investors, their data changes 4 times a year. It's just when the companies report their earnings. So what I can do with the market and the amount of data we have access to, by being really curious, I think that's kind of what led me to write those papers, was I just got really curious on a topic. The way I do research on our investments, it's just being really curious and then kind of going down these rabbit holes of kind of maybe reading something or maybe seeing something somebody else mentioned, or some of the screens that I run, and then just being curious and kind of keeping an open mind. And oftentimes it's not right. Most investments don't work out. That's part of the game. But keeping an open mind and realizing, one, when you're wrong, and to know when to exit a position, and two, keep an open mind to maybe something that you're not aware of, part of the market that you're not familiar to. Maybe there are stocks outside of the Magnificent Seven out there that create opportunities. And so just being really curious, as I think it's probably been my biggest, that I've really benefited from, and trying to latch onto that. And my firm is very much supportive of that. It kind of gives me the rope to be able to kind of just do what I want from the research perspective, and kind of go down these different rabbit holes and see what I can find that can then benefit the portfolios we manage.
No, I love that. And it's interesting that I guess the other question is, then you do so much back testing and so much work on, basically your white papers. How, besides curiosity, how did you kind of get to this point where you're doing more back testing, like more systematizing things? Like, because we all start out a certain way, but at a certain point, people either go discretionary or they get a little bit more systematic. How did you kind of get to that point where you were like, maybe I should be more systematic than just more discretionary?
Yeah, so the portfolios we manage kind of have a little bit of both. So we have like a entirely systematic approach towards how we manage risk. We have a thing called the risk barometer that has inputs that if I got hit by a bus, someone else could pick it up and they could fully run that system. There's nothing of me in it. Same with our kind of the way we do sectors. That's entirely systematic. If I wasn't here, someone else could do it. But then we have a lot of our stock type choices are much more discretionary, where we say, okay, here's a part of the market we really think is strong. Maybe it's a sector or something maybe international, and then trying to maybe find the best stock in that. Maybe there's a chart set up that I think looks really interesting, so maybe we'll buy that. There's a stock I bought this morning that just I don't really know their business real well. I don't need to. The stock looked really good. It met kind of the criteria I was looking for and started a position in it. I don't need to become an expert in their field. I need just to have a good eye at supply and demand. And hopefully a lot of other people come in after me and buy that stock and make the stock price go higher and my clients can benefit from it. It can be that simple of not needing to become a doctor to buy a biotech stock. I don't need to become an engineer to buy an industrial company. I don't need to have a PhD or an MBA to buy a financial by Goldman Sachs. I just need to understand supply and demand. And so really focusing on how I approach the market. Do I have a unique lens? It doesn't necessarily need to be entirely, no one else is looking at the market the same way you do, but to be able to recognize things that set up historically do well. So I will back test, hey, if this happens, do stocks traditionally do well in those environments? Yes. Okay, great. So I'm kind of on to something historically, but not becoming too reliant on that. And I think a lot of new traders can become extremely over reliant on back tests where they think they found the secret key to profits, like you said, kind of the beginning, that making $1 billion off one trade. That's really not that simple. That the market does change, the dynamics do change. What type of environment are we with Fed policy and things like that do matter. It may not be the very first thing I look at, but I'm aware of it. I know what kind of environment we are in economically. I know if the general market is in an uptrend or a downtrend, how's that likely going to impact individual stocks? And so just relying entirely on a back test to do an entire portfolio, I wouldn't probably go that far and be 100% systematic. But I do think there is a lot of benefit, especially from an emotional standpoint, that even as a professional trader, someone who's done it for over a decade, I still know my emotions are going to impact me in certain points. When the market's crashing, even if you're aware of why it's doing it, you're going to have an emotional response to that. And so when you can have certain components that maybe are entirely systematic and your emotions may impact your discretionary side, by recognizing that, understanding that, you're able to kind of put in those safeguards. And also why, since working on a team, that helps us as well, because it's not just one person pulling the trigger on everything. But I think having systems and having backtests can take some of the emotion out, but you still doesn't necessarily mean you can just ignore that you are an emotional person. And that the markets are just basically a measuring block of other people's emotions, other people who are emotionally buying and selling large blocks of stock. Maybe it was someone at Citadel who was going through a divorce and he's dumping a portfolio because he's really upset today. It had nothing to do with what's in the portfolio, but he's having an emotional response and it's now impacting your portfolio because you own what he had. So you have to recognize that other people's emotions are going to impact the market too, and being able to be aware that that's not always going to show up in a back test. You're not going to know when Ray Dalio tries to exit something, or if Warren Buffett starts buying a stock because he had a really good cheeseburger at McDonald's today. That's going to impact you because these big traders are moving the market. And so that's, I think, where you can get offline with a back test and be entirely reliant on just running something that worked well in the 80s and 90s and say, okay, it can work great in the 2020s.
No, I love that because I call it bumper bowling. You know, like in bumper bowling, you kind of have bumpers to kind of keep you safe. That's what I think of systems. And even though I do have a lot of things that are very systematic, the most important thing that I do understand is that my systems, being mainly trend systems, do not work very well in a low liquidity environment. More than anything, I always have to know what environment I'm in. If I can understand that, I can then put on my trades. And I've had a little bit more luck than most of the trend followers in the last few years just because of that. I think that's been my major edge all these years, over than just trying to be like, hey, you know, like you said, like you backtest the turtle trading system. They killed it in the 70s and 80s, you know, and it's buying 50-day highs, selling 25-day lows. Yeah, that would have killed it back then. The moves were quick, they were fast. Now that system is totally obsolete. It had a year where it came back in the end of 2020 into 2021. But besides that, all of those years, basically from 2000 to 2020, were terrible.
Yeah.
So it's like you have to really understand what environment you're in. Build
Mhm.
systems that, and understand like your system might be spitting out that you have a 60% win rate. Cut that to 50 if it's 60. Cut it to, if it's 50, cut it to 40. Also, don't expect, a lot of people expect, like you said, they're going to find something and make 100x on it. And it's like, you expect your systems to be wrong a lot.
Mhm.
And look for systems that have positive expectancy, because most traders aren't right 90% of the time. Systems that are right 90% of the time even blow up.
Yeah.
The main point of your trading is to have good risk management. Look for systems or strategies that have positive expectancy, and understand the environment you're in, because everything else is like it's incredibly important in 2022. For example, why does everything go down? Like you said earlier, correlations go to 1. Why would correlations go to 1? Well, there's no liquidity in the market, so who's going to buy anything at that point? COVID, gold went down, bonds went down at a certain point. Everything started to go down because there was no liquidity to buy anything. And so
Right.
understanding like, hey, are we in a risk on, risk off? Are we in inflationary, deflationary? Looking at like a Dalio style model, however you do it. There's tons of ways to do it, but just understand the environment where what you're in is an incredibly important lesson that you laid down there. Um, I guess the next thing is all these ideas and all these years of trading now, is there any missed opportunities or problems you've had following your own methodology where you kind of went against it? Like you said, like you made jokes about Warren Buffett getting a good cheeseburger and buying something. That stuff happens. People act like that might be funny and you're making a joke, but like that stuff really happens. I've seen people blow up entire accounts by doing things like that. So, was there any mistakes in your past that you could say for our listeners? There's a lot of new traders who watch this. So just anything for listeners to kind of glean off of you.
Yeah, I would think probably the biggest mistakes that I struggle with, it's something that's more than just kind of one-off trading errors, is probably not being aggressive enough. And really something that I've worked on and greatly improved upon is my position sizing. I think it's something that everyone kind of at some point struggles with. And really, for me, it was adding to winning positions.
Mm-hmm.
I wasn't getting big enough in certain trades and really trying to capitalize as much as I could, squeeze as much juice out of it as I could. And so looking back, doing trading reviews, saw that this continued to work, and this trade was doing X, Y, Z. I should have been adding to it, and I could see the points of time where I should be for the systems and the analysis I was doing. And so kind of looking back going forward, I started, okay, I really need to be cognizant of my position sizing and start really trying to build up position sizes when things are working in my favor. And I was pretty good about that on the downside of cutting positions and trying to take smaller losses when appropriate. So kind of, I think trade review can be a really big help. It is for me. I don't do a ton of it still, like kind of on a regular basis, but I do look back at old trades and how could I have done this differently, especially if it was maybe a really good trade, and kind of think, okay, what worked well here that I could repeat, or if it was a trade that really went against me, was there anything I could have done, recognizing that everything looks great in the rearview mirror, but was there anything that I could have seen or could have known at that time that maybe I could have had a smaller loss? And so I think trade review can really be helpful. And then again, because emotion is such a big impact, by doing those trade reviews, and don't do it immediately where you sell on a Thursday and you're doing a trade review on a Friday. That doesn't help you at all. It has to be where you have to get emotionally away from that position, whether it's a win or a loss. And maybe in the third quarter, you start reviewing trades from the second quarter where it's been a couple weeks or months and you're no longer really attached to that stock or position or whatever it was. And then start to really methodically look at those positions and what could you have done differently, or what did you do really well that you want to repeat. And so I think that's something that can be really beneficial. It's boring. No one wants to do it. It's not fun. It's not sexy. No one's tweeting about a trade review, probably, that they did. But I think that's really where you can learn and sharpen your skills. If it's something you really want to be good at, if it's a sport, you're going to practice certain movements. You're going to go to the batting cages if you're a baseball player. I do CrossFit and compete in that, and so I'm constantly working on different lifts or different movements or gymnastics or things like that because I want to get better. And it's same with trading. That you have to really look at some of the finer details. You're on execution or trade review if you're going to improve and take it seriously.
No, that's great. And you're right. It's not sexy. It's not something that people are like, I want to do that. But man, it is so powerful to just go back and you obviously have a problem that most people don't have. Most people have the opposite problem where they trade too big.
Yeah.
So it's probably better to work the way you did and have to be like, I got to step up a little bit. Because the thing I notice so much, and like somebody will send me their portfolio and be like, hey, what am I doing wrong here? And I'll be like, you're every loser in your portfolio is 10% of your portfolio. Like
Yeah.
you will blow up quickly. Like it's
Right.
impossible to make this work. And so it's very interesting, but you only learn those things through reviewing it, bouncing ideas off of other traders. I know so many traders who have never shared their portfolios with anybody, you know, and
Mhm.
like people like you or me, like we have to, our like when we make mistakes, our clients might know about it, or people we work with know about it. It's embarrassing sometimes, you know, because you're just like, I don't want everybody to see my drawdown right now, but it's just the way it is. Like that's how you. And honestly, I've gotten my best ideas, and I've gained so much gratitude for that at this point that I think it's like I always am very transparent. Even my subscribers like get my returns. I think
Mhm.
that's important because they can glean their own things off of it and pick out things like, hey, I like this. Hey, I don't like this. Hey, this was a good trade. Hey, I could have done this better. And for
Yeah.
me, I'm always under review for myself by just being like, hey, maybe I could have done this better. Even winning trades, you have winning trades that you're like you said, hey, I could have stepped up my size here and I'd have done a lot better. And that's kind of like across the board for you. You notice that. That's really
Yeah.
cool. Um, and so I guess the last thing is you mentioned also that you never had much of a trouble with your risk management. Um, what do you do for risk management in your portfolios? Like you mentioned having different portfolio environments and risk gauges, but besides that, do you run stop losses in the portfolio? I know it's more stocks and not like in futures. I have to run stops. The
Yeah.
positions will kill me.
Yeah.
But for you in stocks, how do you do that in your portfolios?
Yeah, so it's I don't really set hard stop losses, and some people they need to. They need that mental I'm out at this price. For
Mhm.
me, it's when the way I approach for individual stocks, because it's different for ETFs. For individual stocks, it's I had a clear reason for buying it. I actually write it down. I have an Excel sheet for
Mhm.
everything I bought, of why I bought it, why I sold it. And so if I have a thesis or kind of a hypothesis, this trade is setting up, maybe it's a breakout trade
Mhm.
and it's broken out of this was prior resistance, it's getting above that, and my goal is that it will just keep going higher as it
Mhm.
breaks out. So if I enter that position on the breakout and then it reverses and falls below that breakout point, that it's telling me that if nothing else is really kind of happening, it wasn't based news event, or I can't kind of justify why the stock is declining. It's okay, this setup didn't work. Would I enter it now? Probably not, because now I'm looking at a chart of a failed breakout. And so I get out of the position if kind of what I thought was going to happen doesn't happen. And so those are for shorter term trades. For other things that maybe I give it some more wiggle room to where I let the position maybe pull back using that same example. And I say, okay, here's where prior support had been. So the
Mhm.
positions come back into maybe a trading range, and typically it's going to find support at XYZ price, whether it's moving average, prior low, whatever it is. If then it breaks below that, say, okay, well, this used to be support. This used to be an area that buyers would come in this market in, and that's not happening now. So this is the market telling me supply is still overwhelming demand, that we're still seeing more sellers come in. What was a breakout failed, now I have a support level with moving average, parallel, whatever. That was support. That's not holding support. This is the market telling me that I'm wrong and that this stock is under distribution. Is it something I still want to hold on to? Now, this may mean it's a 5% drawdown, a 10% drawdown. Maybe it just depends on kind of the volatility of that stock. So I'm not as concerned about the absolute loss I'm taking. It's more looking at it as this is the market's telling me that this stock is probably going to keep going lower, or at least it's just in distribution right now, and I don't want to own it. I'll put it back on a list. Maybe it'll set up again. I can buy it in a couple weeks. It's not kind of a loss. I can never trade that stock again. But I kind of look at each position as it builds and as it grows, or as the stock changes. Is the thesis continuing? Does it still look like this stock is in demand? Is the relative performance to the market? Am I getting paid for the beta I'm taking? Is it still doing well against the broad market? Does it look like there's still accumulation happening in this chart? If that's the case, then I'm going to hold that position. If it gets to the point where maybe it's getting too stretched, it's kind of parabolic move, maybe pull some of it back, manage the position size of it. But I look at it more kind of a discretionary lens for the selling side, by doing analysis on a daily, because it's my full-time job. I have the ability to sit all day and watch it. And so I'm not actually trading every day. I do. There's days where I don't trade anything, which, again, there's a lot in this job that's not maybe as sexy or fun that people think. It's not Wall Street where you're just constantly plugging in trades. But there's a lot of days where you're just doing nothing. And sometimes that's great. If I'm not doing nothing, that means I'm also not selling anything at a huge loss. It may mean that my positions are working well. So not doing anything is not necessarily a bad thing. But I try to do it more discretionary, looking at each position and how that chart is unfolding, and then determine if I either need to take profit here, or if I'm getting kind of stopped out, the setup doesn't look good anymore, then exit a position that way. But because of the size that I trade, it's different than someone who's trading their own account. They have to be cautious of how big. That's probably why I don't get too big. If I make a huge position size, I own too much of a stock. It's too hard to execute. So that's probably why my issues never be getting too big. Schwab won't probably let me do it. It just would be really hard to get a fill on that position size. But be aware of how much you're going to move a market when you're doing it institutionally like I do. And so just to answer your question, I do it more discretionary. I don't set absolute levels. I don't take anything more than a 15% drawdown. I don't have anything like that. But for some people that's needed and it's necessary. If that's kind of where they feel like they need to get the edge from managing their losses that way. So it's not a bad way. That's just how I do it.
Yeah, no, I mean, I tell people, because I'm very systematic in that strategy, but I also tell people, I know there's people who do it just by setting it at certain levels. Technically, the thing that I have known and always noticed is there is really no way to risk manage well without looking at the charts. So, everybody who risk manages well, they all look at the charts. They use ATRs, they use implied moves, they use whatever. There's a million different things, technical levels, moving averages, whatever you want to do.
Everyone becomes a technical analyst in a bear market. Everyone starts looking at charts in a bear market.
Yep. And it's funny because even working with, and I'm sure you've worked with tons of fundamental guys, they look at the charts too. Everybody sees the charts. Every single person pulls up a chart before they hit buy or sell. And also the other thing that's important is to say is, if you are managing the amounts you're managing, setting a stop loss is kind of giving a signal to the market to hit it, like that's.
I could never leave a stop loss out. It would have to be a mental stop loss. I couldn't just set it out there and
you couldn't even put a real stop loss in there because of that. So so that's also incredibly important to also add is your size is being a certain size is also incredibly important, and that's also a skill too of managing money when it's thousands of dollars is whatever. It doesn't stress me out, doesn't hurt me. Maybe when I was younger and starting, it was the end of the world. Now it's like whatever. But when you start to get to 7, 8, 9, 10 figures, like then you're kind of in this area of going like, oh crap, like I have to do this differently. I have to manage this differently. I can't set my stop losses out there because some of these positions, they're going to just try to whack them to make it sell, to get kind of a waterfall. I mean, there's all types of things. So people have to understand, like, there's a big difference between managing your own money institutional, because that's the thing. I'll see people all the time talk about, oh man, this guy had 1,000% return. And I'm like, yeah, with $1,000, like that's not insane to do. But when you're managing, millions and millions of dollars, like having that type of return means your volatility. You have wobbles in a day that are 7, 8 figures. That's wild, and so you have to be
microcap stocks. Like there's a lot that we just can't even go into if it's not trading enough volume.
Yes.
So plenty of things we'll see. Like this would be a great opportunity. I just can't. I would be on the board of this company now if I tried to buy their. So we're kind of limited to the number. So we'll express that, maybe use ETFs to try to give. We were wanting like smaller cap exposure, because they can't go in a stock that trades 10,000 shares a day. It's just not going to happen.
Yes, I mean sectors like gold miners, uranium, like you're going to run into those things over and over again. So it's important to understand that there's a difference, because you'll see people be like, man, the returns for funds are not as high as this, and it's like you're managing a crap ton of money. It changes the game completely.
Right.
which is awesome, but also it's just a different skill. Like I also think about it like it's a major skill to be able to handle that type of money, that type of drawdown. It's very commendable. The amount you're talking about is even bigger sizing than I've ever seen. So that's pretty cool. That's awesome to hear.
Yeah, it's a different goalpost. We're not, like I said at the beginning, my goal is not to hit home runs with every portfolio we're managing.
Mhm.
We have some portfolios that are more aggressive, and we're able to be more aggressive in those. But primarily for the majority of the families we work with, they're not trying to hit 50% annualized return gain. That's not their big. The amount of risk to take to get that is beyond what they would ever want to take on at their stage in life. So it's kind of recognizing what is your ultimate goal, and then fitting a strategy that meets that goal, not just trying to always hit home runs.
And it's also important to note that just as a person who's had clients who are looking for 50 to 100% returns a year, you don't want to deal with them anyways. They're completely unrealistic, and they're, and that it's just something that's completely unrealistic. And those years happen, sure, like, but they have to happen. I mean, I'm a futures trader. I trade a lot different size than you do. So that makes it work differently.
Yeah,
People sign up for that type of volatility, but in the retirement accounts, people aren't signing up for that type of volatility. So
right,
it's just two
exactly.
different worlds. So just to end things off, any lessons for new traders, something that you would have liked to hear when you were in your first couple years of trading, kind of going around trying to learn strategies or how you were going to trade.
Yeah, I would say the biggest thing probably for new traders is simpler is always better. Like the papers I wrote were very, very simple. They're not earth-shattering topics. The charting that I do, the stuff that I publish in Thrasher Analytics, or I share publicly on Twitter, different blogs or whatever, are all very simple concept ideas. Some of the traders I'm very good friends with, that I have a lot of respect for, do very simple analysis. Their charts aren't covered in 12 indicators, in 7 different types of Fibonacci and moving averages and all that. They're very simple. So I think taking a simplified approach is the best thing possible you can do with looking at the markets. And maybe you get really honed into one type of indicator. You're really into momentum type trader, and that's what you focus on, but not trying to apply one concept to every market and try to apply 12 different indicators to every chart you look at and all the different time frames. And just because you can doesn't mean you should. With technology we have now, and it's so easy to chart, so many websites where you can slap so much data onto one chart, that I think it really makes it more confusing. You're going to see signals and analysis that aren't truly there because you're forcing it. So I think being as simple as possible. Some of the best chart and technicians out there, their stuff. The common thing is they're very simple, easy to understand. They're not covered in indicators and lines and all these things. The newer traders, the ones that probably are trading in their mom's basement and managing $12 portfolio at E-Trade, they're the ones with so much crap on
Yep.
their screens, and they feel like they need to have 12 monitors. I have 3, and I probably don't even need the other 2.
Yep.
Have a simplified approach, have an open mind, read as much as you can. I try to read a lot of not just news, but books and what other commentaries and things like that, because that's how you're going to find ideas or unique ways of looking at things. Um, so that's probably would be just simple, keep an open mind, and read as much as you can.
No, I love that. And even for myself, and as the years go on, I remember, even like 5 years ago when I started to try to build volatility strategies, I was pulling up every single thing I could possibly do. And in the end, the strategy was 2 indicators. The one I built off of your idea was just 2 indicators in the end, and that's all
Yeah.
it needed. And so it's very interesting because if I think of the millions of times I've asked this questions to people, the answer is always simplify. Dumb it
Yeah.
down, simplify, dumb it down, simplify. And like it's the truth, because if you're looking at, if you can't, and my nephew is now starting to trade, and he's asking me about charts and what to do. And I said, you look at this, if you can't look at a chart and tell me if it's in an uptrend or downtrend without any indicators on it, you don't know what you're doing yet. And that's okay, but you got to learn how to read a chart without any indicators on it, because all the indicators are is just, moving averages is smoothing a certain amount of days. All the rest of them are just, they're all taken from price anyway, so you have to learn to just read the price.
Yeah, I agree.
Well, cool, man. Well, thank you so much for coming on, dude. This was a
I appreciate it.
blast. You really nailed some great concepts. I'm sure like all of our people are going to love this because you nailed some great concepts. And like, I think the thing that you talk about in trading and in life and everything is like you simplify,
Right.
And so I think that was super cool. And this was a lot of fun. And thank you so much for coming on.
Yeah, thanks for having me.
Of course, man.